What's going on, everyone, and welcome back to Freshman Finance. My name's Patrick.
And I'm Basha, and today we're talking stocks, bonds, commodities, and REITs. These are some of the more popular asset classes you can buy.
Let's go. Let's start off with the sexiest asset class out there, stocks. Stocks sometimes have a couple different names. They're also referred to as equities or shares. Essentially, it means the same thing. Now, what a stock is you're basically owning a piece of the company. So let's say that you bought one Apple stock. You now own a very small percentage of that company.
And the reason that you're going to invest in a stock is because you think the company is going to be profitable long term. So keeping it very simple, let's say the company had a great year. It's likely that their stock price will go up, which means that you will benefit in that and get a piece of the pie. However, keep in mind that the opposite is also true. So let's say they had a shit year. They really didn't meet their performance target. It's possible that their stock price will go down as a result, which means you will be burned to the downside.
Now, there's a number of different variables that makes a stock price rise or fall. As Basha mentioned, it's profitability, sometimes it's a change in management at the company, the products that they're releasing, or the geopolitical environment as a whole. So make sure that you do your thorough research before investing your money in any individual company.
And that's probably one of the reasons we don't buy individual stocks, is because there's so much work involved and so many variables that are very hard to determine whether the company long-term is going to be successful. So we take the lazy route and we actually invest in index-linked mutual funds and ETFs. If you're interested in learning more about these instruments, be sure to check out our videos on index-linked mutual funds and ETFs. We've posted the link below for you guys.
The next major asset class we're going to talk about are bonds. Since this is Basha's area of expertise, I'm going to throw it over to the bond girl.
Thanks. So companies, governments, municipalities, government agencies all look to raise money in the markets. And one of the ways they can do this is by issuing a bond. If you buy a bond, you are essentially lending that company or government money, and they agree to pay you back that investment that you made at the end of the term. So bonds are sometimes referred to as fixed income securities or debt securities.
Boiling it down to its core, a bond is essentially an IOU contract between two parties. Let's take a real life example and say that I want to buy a brand new shiny Mac, but I am broke. I have no money. So I look to someone close to me and try and raise the £1,000 I need to buy that new shiny laptop. Would you agree to loan me that money in order for me to buy my new laptop?
Okay.
£1,000?
£1,000, but you have to pay me the money back in 1 year's time.
1 year I can do that.
Agreed?
Deal.
Agreed.
Deal.
So Pat and I essentially entered into a basic bond contract. However, one thing to keep in mind is I feel a little bit gypped. So Pat gets his brand new laptop and I give him £1,000 to do it. However, I don't really get anything in return. So for a whole year, I'm out this £1,000. Now imagine what I could have done with that £1,000. Bought a spa trip, great weekend away, multiple weekends away, let's be serious. And I kind of need something in return. So I have a better deal.
Okay.
I will give you £1,000 today.
Mm-hmm.
You have to pay me back in 1 year's time, £1,100.
I really want that laptop, so...
Deal?
Deal.
Deal. Now we have a proper bond contract. So let's go over the basic bond terminology. You've got the principal, which is the loan amount. In this case, the £1,000 that I agreed to lend to Patrick. We've got the term, which is 1 year. He owes me the money back in 1 year's time. And we've got the coupon, or the interest on it, which is 10%, the £100 that I'm gonna get back on top of my £1,000 loan. Essentially, this is what happens in the market every single day with large corporations or governments. They go out to investors, they ask them to lend money to these companies, and they agree to pay them back at the end of a certain period with interest.
Now, if stocks are at the sexy end of the spectrum of asset classes, Commodities are at the complete opposite. They are boring, but they are necessary. Commodities are the raw materials we kind of use in day-to-day life that really make up the building blocks of our society. And they can be broken down into three main categories: energy, metals, and agricultural products.
So for example, we're talking natural gas, oil, gold, silver, wheat, soybeans, coffee, sugar. Like, I could keep going, but you guys get the point now. These are the commodities that can be traded in the market.
And commodities are a fantastic way to diversify your portfolio. They're sometimes low or even negatively correlated to the price of stocks and bonds. So if the price of stocks and bonds is falling dramatically, commodities could be on the rise.
Exactly, and another reason you want to consider commodities in your portfolio is because they are usually unimpacted by rising inflation. So if inflation is going up, the value of the currency is going down, usually referred to as currency depreciation, which impacts the price of stocks and bonds. So as currency goes down, stocks and bonds go down. And since commodities are relatively unaffected, they could be rising in value. A very famous example of this is if the US dollar is falling in value, depreciating, people are buying gold because it's becoming more valuable.
And you can buy commodities directly or indirectly in the market. So, for example, you can go out into the market and buy 1 ounce of physical gold. Or you can actually invest in a company who produces that commodity itself, something like a gold mine. And finally, let's talk about REITs. These are a lesser known products than stocks and bonds, but something we think is really important. REIT stands for Real Estate Investment Trust, and this is a great way to invest in the property market without actually owning the property itself.
Investing in property is a great way to diversify your portfolio, but as we know, investing or buying an actual flattened house can be relatively tricky. So you can buy a REIT, and therefore you can gain from any rise in property as well as any rental income from those properties.
It's pretty sweet. It's like getting all the upside with none of the downside. You're a landlord, but you don't have to deal with crazy mortgage terms, a massive down payment, insane tenants, or the basement flooding.
Exactly. And as the name states, REITs are not companies, they are trusts. So if you invest in a REIT, you become the shareholder or the beneficiary of that trust.
And like stocks and bonds, REITs are traded daily in the market when it's open, and they also pay you a dividend.
So they're managed by professional managers. So the REIT goes out there to buy, sell, develop, and manage the properties, and it can be in the industrial, commercial, or residential space. And any value that they get or gain from these properties, they'll pass on directly to you after fees, of course. As with any asset class, though, there is downside. So if they lose any money on these properties, they'll also pass those losses on to you.
Traditional property investment can be great, but sometimes it's really expensive, especially in the commercial space. So REITs are a fantastic, cheap option to really invest in that real estate market itself. Like commodities as well, REITs are not necessarily directly correlated to stocks and bonds. Therefore, it's a great way to diversify your portfolio. And that brings us to an end of another episode of Freshman Finance. We hope that you guys now have a basic understanding of the main asset classes that you're likely to come across, and you can impress your next dinner guests.
Exactly, and we encourage you guys to watch this video a few times to make sure that you really understand the difference between stocks, bonds, commodities, and REITs. As always, thank you so much for watching the video. Don't forget to leave your comments in the comment section below, and we can't wait to see you guys in the next one. Bye.